Back in February 2025, when Bitcoin fell below $85,000, Michael Saylor posted a line that became famous among Bitcoin believers. Sell a kidney if you have to, but keep the Bitcoin. And yet today, his own company, Treasury, is selling Bitcoin.
When Treasury sells Bitcoin, how should investors interpret that? Is this business as usual, or is this a signal of something bigger?
But the real question isn't whether Saylor broke his promise. The bigger issue is that Strategy's financial structure is beginning to force the company to sell Bitcoin. What's actually happening? This video is sponsored by Plinko. One, Strategy isn't simply buying Bitcoin. To understand this, we need to look at how Strategy raises money. Strategy has issued multiple forms of preferred stock sitting above its common MSTR shares. These securities pay investors cash dividends, and many of them have no maturity date. In simple terms, Bitcoin can go up or down. But Strategy's bills still have to be paid. One of the most important examples is STRC, or Stretch. It launched with a 9% dividend rate. But when the price falls below a certain level, the dividend rate can increase to attract buyers. By July 2026, that rate had climbed to around 12%, and that's where the problem begins. 2. The cash burden is growing fast. In the second quarter, Strategy paid around $400 million in preferred dividends. Meanwhile, the company's entire software business generated only about $122 million in revenue. That's revenue, not profit. So the preferred dividend bill was more than 3 times the entire revenue of the company's traditional business. Total preferred and interest obligations are now estimated at roughly $1.2 to $1.7 billion per year. Just 1 year earlier, preferred dividends were around $49 million per quarter. That's roughly an 8-fold increase in 12 months. So where does Strategy get the money to pay for all of this? 3. The funding machine that powered Strategy's Bitcoin buying for years, Strategy had a major advantage. MSTR traded at a substantial premium to the value of the Bitcoin on its balance sheet. That allowed Strategy to issue new shares at high prices and use the proceeds to buy more Bitcoin. When the stock trades above the value of its underlying assets, issuing shares can actually increase the amount of Bitcoin backing each share. It creates a powerful loop. MSTR rises to new shares are issued, to more Bitcoin is bought to Bitcoin per share. Increases to the story becomes more attractive to MSTR rises again. The model works beautifully when the stock trades at a premium. But when that premium disappears, the entire mechanism starts working in reverse. 4. When the premium disappears, issuing stock becomes a problem. Using the basic calculation described in the original script, MSTR is now trading at roughly 0.68 times the value of its Bitcoin assets. In other words, the market is valuing the company significantly below the Bitcoin it holds. And when shares are issued below net asset value, issuing more stock no longer creates value. It can actually destroy value for existing shareholders. Strategy has raised more than $17 billion this year through stock issuance. But once the market stops giving MSTR a large premium, that source of capital is no longer unlimited, and Strategy has to look toward its biggest asset, Bitcoin. 5. Bitcoin becomes a working capital account. In the latest disclosure discussed in the script, Strategy sold around 1,638 BTC, generating roughly $105 million. About $52 million went toward preferred dividend payments. Another $52 million went toward buying back Stretch shares. In other words, Bitcoin was sold to pay the securities that were created to help raise money to buy Bitcoin. That's the central paradox of the model. The company is selling Bitcoin to maintain the financial structure that allows it to keep owning Bitcoin. And there's another important detail. Strategy was also issuing common stock during the same period. In that same week, the company sold more than 3 million common shares, raising around $290 million. About $250 million went into its dollar reserve. Is Strategy selling Bitcoin while also issuing equity? If both happen at the same time, it could signal that Bitcoin is being used as a working capital source. 6. And this isn't just a Strategy problem. Around 200 public companies now hold more than 1.2 million Bitcoin collectively. Many of them are using a similar strategy. Raise capital, then buy Bitcoin, then use the Bitcoin Treasury to support the next round of capital raising. But once these companies begin trading below the value of the Bitcoin they hold, the engine starts to break down. According to the data in the original script, a basket of digital asset treasury companies fell roughly 43%, while Bitcoin itself fell around 27%. Some companies have already started liquidating their Bitcoin. Satsuma liquidated all 668 BTC it held. BitDigital sold 948 BTC as it pivoted toward AI. These companies operate in different countries and have different management teams, but they face the same structural problem. Their assets are highly volatile, while their cash obligations are fixed. 7. Is Strategy about to go bankrupt? No, not yet. Strategy still has around $4 billion in dollar reserves, enough to cover roughly 2 years of dividends and interest. Total debt is around $6.7 billion, and the $8.2 billion quarterly loss was largely driven by the mark-to-market revaluation of Bitcoin, rather than $8.2 billion of actual cash leaving the company. So this is not simply a story about Strategy is going bankrupt. It's a story about a financial structure coming under pressure.